The trading world is obsessed with the swing trading versus day trading debate. Are you glued to the screen for quick wins, or patiently holding for bigger moves? This choice seems to define your trading identity. Online, gurus argue endlessly, each claiming their method is the only path to success. But the truth is, the best traders don't pick sides, they use both approaches as tools. The market isn't black and white, it rewards adaptability, not rigid rules. The real secret? It's not about choosing speed or patience, but blending both. The pros manage risk and build robust systems, not identities. This video will reveal how professionals think, moving beyond the tired swing versus day trading argument. Let's pull back the curtain. Day trading is a sprint, quick entries and exits, small profits, no overnight risk. Every second counts and decisions must be made in the blink of an eye. The market moves fast, and so do you. The thrill of catching a quick move can be exhilarating, but it's also relentless. You're glued to your screen watching every tick, every candle, every headline that could move the market. There's no room for hesitation, and the pressure to act quickly can be intense. It demands laser-sharp focus, racks up transaction costs, and can be mentally exhausting. The constant need to monitor positions and react instantly can wear you down, both physically and emotionally. Many day traders find themselves chasing losses or second-guessing their decisions, leading to burnout if they're not careful. Swing trading, on the other hand, is a marathon, holding positions for days or even weeks. Here, patience is your greatest asset. You're not chasing every tick. Instead, you're waiting for the right setup, the right trend, and letting your trades play out over time. This approach allows you to step back, analyze the bigger picture, and avoid the noise of intraday volatility. Swing traders aim for bigger moves with less screen time, often balancing trading with other commitments. This style can offer more freedom and less stress, but it's not without its own challenges. Holding positions overnight exposes you to unexpected news and market gaps, testing your patience and your nerves. You have to be comfortable with uncertainty and trust your analysis, even when the market is closed. Day traders rely on short-term charts and momentum indicators, seeking quick opportunities in the market's micro-movements. Swing traders, meanwhile, focus on broader trends, key support and resistance levels, and the overall direction of the market. Your choice often depends on your lifestyle, your risk tolerance, and how much time you can dedicate to the markets. Some people thrive on the adrenaline of day trading, while others prefer the slower, more deliberate pace of swing trading. But here's what most traders don't realize. There's a third way. You don't have to choose one or the other. Professionals don't limit themselves, they integrate both styles, adapting to what the market offers. They know when to be fast and when to be patient. They use short-term trades for tactical moves, capitalizing on immediate opportunities when the setup is right. And they hold longer-term trades to ride bigger trends, letting winners run and compounding gains over time. The real edge comes from combining the strengths of both approaches, not picking one and ignoring the other. Flexibility is the hallmark of a successful trader. It's not about your personality. It's about building a resilient, adaptable approach that can weather any market condition. Stop thinking in absolutes. The market rewards those who can pivot, adjust, and evolve. Start thinking like a pro. Embrace both speed and patience. Onwatchen wanen, abatsen man, obradation on, namrunter ditcher dendand, odrasun nine. You'll unlock new possibilities in your trading journey. Day trading is emotionally intense. Every moment is a test of your nerves, and the stakes feel high with every click. The constant barrage of information, flashing numbers, and rapid price swings can make your heart race, even if you've been trading for years. It's not just about making quick decisions. It's about handling the pressure that comes with knowing your money is on the line, second by second. Every tick feels like a win or loss. The smallest movement in the market can trigger a surge of excitement or a wave of anxiety. You celebrate the green candles, but the red ones can feel like a punch in the gut. This roller coaster of emotions is relentless, and it can wear you down faster than you realize. The stress of rapid decisions can lead to burnout and impulsive mistakes. When you're tired or overwhelmed, it's easy to abandon your plan and make trades you later regret. Over time, this emotional fatigue can build up, making it harder to stay focused and disciplined. Swing trading, on the other hand, tests your patience in a different way. You might wait days or even weeks for a setup to play out, all the while doubting your analysis and resisting the urge to interfere. The waiting game can be just as stressful as the fast pace of day trading, especially when you see the market moving and wonder if you should act. Both styles challenge your emotions in different ways. Day traders battle the urge to act too quickly, while swing traders struggle with the temptation to act too soon or too late. The emotional toll is real, no matter your approach. A day trader might panic after a quick loss and chase trades, spiraling into bigger mistakes. The fear of missing out can push you to jump back in, even when your strategy says to wait. This cycle can quickly erode your confidence and your account. A swing trader might second-guess a good setup after a few slow days, exiting too soon and missing the move they were waiting for. Doubt creeps in, and you start to question your process, even if your analysis was sound. The real battle isn't with the market. It's with your own fear, greed, and impatience. These emotions can cloud your judgment and lead you away from your plan, turning a solid strategy into a string of losses. Emotional discipline is the foundation of success, no matter your style. The best traders know how to step back, breathe, and stick to their rules, even when their instincts are screaming to do the opposite. They journal their trades, reflect on their mistakes, and constantly work to improve their mindset. Professionals know this. They have systems to manage emotions, not just trades. They use checklists, routines, and self-awareness to keep themselves grounded, especially when the market gets wild. If you can't control your reactions, you'll never control your results. Emotional outbursts and rash decisions can undo weeks of careful planning in a single moment. Trading is a mental game first. The charts, the news, the numbers, they're all secondary to your ability to stay calm and focused under pressure. Master your mindset, and you master the market. The real edge isn't in a secret indicator or a perfect strategy. It's in your ability to manage yourself. That's the hidden cost. And the hidden opportunity. If you're willing to do the inner work, trading can become not just a way to make money, but a path to personal growth and self-mastery. Hedge funds don't argue about swing versus day trading, they use both. Their core portfolio is built on long-term analysis, riding big trends for weeks or months, but they also use short-term trades to hedge, manage risk, and fine-tune entries and exits. For example, if their main position is up, they might short the market for a day to protect profits. This hybrid model gives them stability and flexibility. Long-term trades drive returns, short-term trades manage risk. They think in layers, big ideas, managed with tactical adjustments. It's not about picking a side, it's about building a dynamic, resilient operation. That's how the pros do it. Amateurs obsess over profits, professionals obsess over risk. The pros first question, how much can I lose? Not, how much can I make? They plan every trade, entry, stop loss, and target before acting. This removes emotion and guesswork. They look for trades where the reward outweighs the risk, often by 3 to 1 or more. Even if they're wrong more than right, they stay profitable. The secret isn't predicting the market, it's managing risk relentlessly. Capital preservation is their foundation. Think like a risk manager, not a gambler. That's the real difference. Pros use a top-down process, big picture first, details second. They start with macro trends. Is the market bullish or bearish? What sectors are leading? Then, they drill down to the strongest industries and stocks. The core position is built on this analysis. Fundamentals and technicals align. Entry, stop, and target are defined in advance. Short-term charts are used for precise entries and tactical risk management. If the market turns, they hedge or trim positions, not panic. Every layer has a purpose, strategy, execution, and risk control. This methodical approach keeps them focused and objective. It's not about reacting to noise, it's about following a plan. That's how you trade like a professional. Structure beats spontaneity. You don't need a huge account to trade like a pro. In fact, some of the most disciplined and successful traders started with modest amounts. What matters most is your approach, your mindset, and your willingness to stick to a proven process. With the right strategy, even a small account can grow steadily over time. Start with the big picture. Use daily and weekly charts to set your bias. These higher time frames reveal the dominant trends and help you avoid getting caught up in short-term noise. By understanding where the market is headed overall, you can align your trades with the path of least resistance. Only look for trades in the direction of the main trend. This simple rule keeps you on the right side of momentum and increases your odds of success. Fighting the trend is a common mistake. Let the market's direction be your guide. Before you enter, check for any major news or events that could disrupt the trend. Staying aware of the bigger economic picture helps you avoid surprises and trade with confidence. Use smaller time frames for precise entries. Wait for confirmation before acting. Patience is key. Let the setup come to you, and don't rush into trades just because you're eager to participate. Look for clear signals that align with your overall bias. Always define your stop loss before entering a trade. This is your safety net, protecting your capital from unexpected moves. Decide in advance how much you're willing to risk, and stick to it no matter what happens after you enter. Risk only a small percentage of your account on each trade, never more than 1 to 2%. This keeps you in the game, even if you hit a losing streak. Consistent risk management is what separates long-term winners from those who blow up their accounts. Calculate your position size based on your stop loss, not your hopes. Let the math guide you, not your emotions. This discipline ensures that every trade fits your plan and your risk tolerance. Blend swing and day trading, big ideas, precise execution. Use the broader trend to find opportunities, then zoom in for the best entry points. This hybrid approach gives you the flexibility to adapt to different market conditions. This process removes emotion and guesswork. By following a structured routine, you make decisions based on logic and evidence, not fear or greed. Over time, this builds your confidence and consistency. You're not just a swing or day trader, you're a systematic trader. Use structure, not impulse. Document your trades, review your results, and refine your process. The more systematic you become, the more control you have over your outcomes. That's how you bridge the gap from amateur to consistent trader. Progress may be gradual, but every step forward is a win. Celebrate your improvements and learn from your setbacks. Make every trade part of a bigger plan. When each decision fits into your overall strategy, you trade with purpose and clarity. That's the real secret to lasting success in the markets. Amateurs react, professionals plan. The amateur jumps into trades on impulse, driven by fear and greed. The pro prepares before the market opens, analyzing, planning, and defining every move. When the market opens, they wait for their setup, then execute without hesitation. If the setup doesn't come, they do nothing. Their risk and exit are predefined, insulating them from emotional swings. They follow their plan, not the market's chaos. This discipline is the real edge. There's no magic, just preparation and execution. That's how trading becomes a business, not a gamble. The swing versus day trading debate is a distraction. Pros use both, blending time frames into a single, risk-focused process. The real journey is shifting from chasing profits to managing risk. Build a structured plan, use higher time frames for direction, lower time frames for execution, and always control your risk. Your trading account is your business. Treat it that way. Forget the online arguments and focus on process, not prediction. The pros don't react, they plan. Trade with structure, not emotion.